Good afternoon, everybody. Here we are for Monday, 29th of July 2019 for session 49 and the final session of the Admiral Markets webinar series of Mastering the 4 M's of Trading. My name is Paul Wallace. I've been your guide for this series. I'm a trader, analyst and coach. And as always, we'll start with a quick risk disclaimer. Trading with financial instruments offered by Admiral Markets carries a high level of risk which is not suitable for all investors due to their complex nature. Before entering into client agreement or making a transaction, please make sure to read the terms and conditions of our service. Consult a specialist if necessary to ensure you understand the risks involved in trading. This presentation and accompanying videos for information and educational purposes only. Online educational materials are developed by Admiral Markets and distributed by Admiral Markets Group investment firms for a global audience. Therefore, please take into consideration that the information in this session may not be suitable for everyone. The presentation and accompanying video should not be taken as advice for investing, as they only represent the personal opinion of the authors. As of August 2018, the regulation within the European Union differs for retail clients and professional clients. In our presentation, we use demo trading accounts where all clients can still use a high leverage in a risk-free environment. Before opening a live trading account, please consider the differences between retail and professional trading terms. Retail clients benefit from unlimited negative balance protection. Professional clients at Admiral Markets UK receive a compensation of account deficits with a maximum payout of £50,000 sterling as per our negative balance protection policy. Admiral Markets is a truly global brokerage that offers fantastic trading opportunities on very popular trading instruments. There you can see the DAX 30 and the Eurodollar with very competitive spreads during main trading hours, and they also offer the MetaTrader trading platforms in both MT4 and MT5 versions, but also with the Admiral Markets Supreme Edition plugin. As I said, they're truly a global brokerage who are regulated across several entities throughout the globe. If you speak to your account representative, they'll be very happy to guide you in opening an account in the most suitable entity for yourself. As always, ladies and gentlemen, through these sessions over the last year, it's been my job to help educate you about the 4 M's of trading so you can go away and analyze any market and be ready to trade it, and help you raise your own self-awareness about managing your risk and managing yourself. For yourself, ladies and gentlemen, as always, I appreciate when we watch these through that there's always been a broad range of experience in the room. We're always operating under time limitations, which basically means that we're sometimes limited on the breadth and depth within which we can go into topics, but we've always been trying to focus on tools that you can utilize tomorrow in your trading endeavors. And throughout this whole series, what we've looked at is trying to be able to make sure that you're able to master the 4 M's of trading. Because when a trader masters markets, method, money, and myself, they're operating in a sweet spot that allows them the opportunity to trade to the best of their abilities. As I said, over the last few weeks, we've been covering the last few sessions of the Mastering the 4M of trading, and this, as I said, is Monday, July 29th, session 49, and we're going to focus on the sort of the last few steps that we covered, which was really all towards about managing myself, about being a professional with a business rather than an amateur with a hobby, and that's what we're going to be doing as a recap today. I guarantee you'll be watching this on demand on either the Admiral Markets YouTube channel or the Admiral Markets Facebook page. You should be able to find all of the other previous sessions there. So even though we're doing a recap on myself, you should be able to find all of the other sessions there that you can access to go into some of the areas with greater detail as we did during the sessions. So, as I said, we've covered over the last few weeks is about how we prepare for our trading day, how we follow our 10 steps, how we do our market analysis and how we choose our entry, how do we go about managing our risk, and how we can record and view our trades, and how we manage our trading performance. And those final two are what we're going to recap today. That's what we've actually been talking about, and where we're going to finish in the kind of our last session together today. So, what we'll be talking about is, if you remember last session, we talked about managing risk, okay? And that managing risk and also managing reward becomes really key for a trader, in terms of being able to manage your own performance. It's about being able to understand your risk profile and understand, the sort of the basic relationships between risk and reward within trading. There can be no reward without risk, and it's about being able to manage that and how effectively you do so that will help you master those 4 M's of trading. So, how does a trader manage those risks versus reward? Well, what we talked about in greater detail during the session a few weeks back was about often traders refer to it as the 3 R's, okay? The risk to reward ratio. It's about understanding that, okay? That actually helps us choose better trades. So it is really risk to reward is about a balancing act, okay? And a part of that is defined by your own risk profile. So we here at Admiral Markets can pretty much teach you most things about trading, okay? In terms of educating you about markets, about methods, about money and myself, we can really do educate you on pretty much all of those. The one thing we can't is you understanding your own risk profile, right? That is what has to come from you. And that's, we realize that some traders are very aggressive and some traders are very cautious. If you want to read more about that, then refer back to the session we did on greed-based trading versus fear-based trading. And it's absolutely fine. There's no right or wrong. It's about understanding your own risk profile. You are most likely to be successful when you trade in line with your own risk profile. So what we talk about is, you'll hear me talk about is, I believe in asymmetric trades. For those of you who ever joined us for the Admiral's real-time daily trading ideas, that's what I would always be talking about. I always be showing asymmetric trade ideas. Why? Because it removes the need to be right on trades, right? And removing that need to be right is what helps take the pressure off our shoulders as traders. We're going to talk a little bit more about that. We're going to recap that over the next slide or two to just try and help you understand that better. So, we talked about this, a good couple of months ago about understanding the kind of the relationship between risk to reward. If we look across the sort of the top axis, we can see what we have is our strike rate, or what people might call our win rate. So we can see, what happens when we have a win rate of 20%, 30%, 40%, 50%, even 60%. What we also have to do is, recognize the sort of our risk to reward ratio. So here down the side, we've got the top to 1. So when we have a risk to reward ratio of 1 to 1, so whatever we risk, we're looking to make the equal amount. Well, then what we can see is that really it's only up till actually we're getting 50% that we're break even, and we have to be right 60% of the time and above to actually be consistently profitable. Whereas if we go down to the very bottom left, we can see that if we have a risk to reward ratio of 5 to 1, so for every, let's say for every 100 euros we risk, we generate 500 euros of return. Well, then actually we can see that from 20% strike rate, okay, only being right 2 times in 10. That means we're actually profitable, and we're able to be profitable all the way up the ladder. So what we just try to sort of kind of hone that, having an asymmetric reward to risk ratio, being able to generate more reward than you're risking for your trades allows you to have a lower win rate. Now, of course, everybody wants an 80 to 90% win rate. Okay, we're only human, but with the best will in the world, with the best will in the world, markets don't always operate like that, and we have to be prepared to have clusters of winning trades and losing trades, and it's a case of realizing, understanding that somewhere within that area, that in that sort of risk profile, or rather somewhere within that risk to reward ratio, you'll be able to understand your risk profile. So for me, I'm very happy to have a strike rate of 20 to 30%. Because I know that my risk to reward ratio is normally somewhere in the region of 3 to 6 to 1 on my trades. Other people would be need to be right. They have a need to be right, and so they want a win rate of 60, 70, 80%. But their risk to reward ratio might be 1 to 1 or even below that, and that starts to become very difficult on in terms of the margins. Okay, the margins for being wrong sort of rapidly decline. So what we always talk about, traders, as we're going to talk on later on, is about once you understand, once you've been keeping good records, you can work out where you sit on this particular matrix, and and then from that you can start to actually work out what you have in terms of positive expectancy or negative expectancy. So, as I said, I'm very happy, and I'm always looking for asymmetric reward to risk ratios on my trade. But I appreciate that sometimes it's not always easy for new traders to follow. And why is that? It's because actually what you realize is that, especially for new traders and humans in general, people need to be right more than they need to be profitable. Which I know might sound a bit weird for traders, but actually we have a greater need to be right than to be profitable. Especially, it might be said for young men. Okay, we don't like being wrong, and we don't like losing money, but invariably that is part of the trading experience. And so what you'll find is that even though asymmetric reward to risk ratios take off the pressure, what you'll find is most new traders will actually naturally drift towards higher reward to risk. Or higher, reward to risk ratios, in terms of they want a win rate that is higher rather than the reward to risk ratio being high. So that was just remembering in sort of a reminder of the sort of understanding the relationship between risk and reward, and how you understand your own risk profile. Step 8, if you remember, we're talking about managing trader performance, is about recording. Okay. So, we always pose this question about, is it possible that your trading results for that session could be determined before you even switch on your computer? And very clearly, we're very quick to sort of to point at that and say, well, actually, yes, it is indeed possible. And what we say is that, new traders find it difficult to recognize the importance of that trader's mindset, okay, about managing myself. Most new traders, they focus on the method of trading, how to buy and sell. They love it, okay? They absolutely love it. When I run events in London for traders, the new traders, they all want to talk about the methods of trading, how and where they buy and sell in the markets. However, experienced traders' focus is considerably elsewhere, and that's what we're actually sort of looking at to try and understand. So if we think about an amateur trader's focus or a new trader's focus goes with regards to those kind of the 4 M's that we've talked about, methods, market, money, and myself, as I said, just take a moment to think, where do you think, in terms of percentage, where that focus would go? Well, actually, what you'll find is that primarily about 60% of the focus goes on method. As I said, they want to know about, where to buy and where to sell. Maybe 30% might go on to markets itself, understanding the market, always wanting to work out where it's going and if it's moving. Actually, only a little bit might be going on sort of onto the money side of it, and even smaller side going on to managing myself. Whereas, when we look at a professional trader's focus, well, we'll see that there is some, a good deal of difference. What we'll see is, for those same 4 M's, method, markets, money, and myself, what we find is actually the method is only maybe 10% of focus. Markets, maybe about 15%. We just want to know what kind of environment that market is trading in at the moment. We'll have a good deal about sort of just more increasing in terms of managing money, managing the risk management side. and actually a huge amount more becomes effectively about managing myself. Okay, but you get towards around about 2/3 of it. It's about managing myself in terms of being able to put yourself in a good space to trade before the market, before the market's even open. And here's a great quote from Tom Basso, who's featured in the wonderful book Market Wizards, where he says, "I think investment psychology is by far the more important element, followed by risk control, with the least important consideration being the question of where you buy and sell." He's absolutely right. Mr. Basso is a very popular, very successful trader, and I concur with his quote there, absolutely 100%. If you want to know more, Paul Tudor Jones is a very, very successful fund manager, and he said that profits come from happiness, not the other way around. Now I spend my day trying to make myself as happy and relaxed as I can be, and he's absolutely spot on it. Profits come from happiness, so it's about you putting yourself in a good space before you even sort of switch on your computers to start trading. That will actually have more of an impact on you trading better rather than what the actual markets are doing. So what we can learn from this is, simply focusing on your trading method is not enough. Trading is a performance activity. It's not about the sort of Monday to Friday 9 to 5. So as traders, you need to develop that performance mindset so you can manage yourself. And that mindset is what provides you with the mental toughness to be able to handle whatever happens in the market. So, with regards to what can new traders expect, well, new traders, they get caught up in the excitement of trading, right? They look at markets like a big jackpot machine, and they only see the possible profits. They don't see the possible downside, and that's what becomes important. What we want is to realize is that trading is a journey. Okay, it's not necessarily a destination, and like every journey, you're going to have challenges and obstacles to overcome, and you should expect them as part of your journey towards being a consistently successful trader. As the old adage goes, a box in the ring, you can't get into a fight without expecting to take a few hits. And trading is the same. All right, you just make sure that you keep your hits small. And the way you keep your hits small is by actually what we touched on and recapped last week is about managing risk very, very clearly. And so that's, you look at simple ways that you can help yourselves. Well, one of the sort of the bigger pictures we talk about is about actually, rather than calling yourself a trader, you're a profit planner. You're planning for profits, all right? So don't just start the day by opening charts and looking for a trade. Do your analysis and start planning profit opportunities. Start looking at it as an opportunity to take money from the markets rather than give it. Look at becoming a profiteer. So you don't guess, you don't trade, you wait. And sometimes I appreciate that can be very, very hard for new traders. So you treat this like a business, because if you want fun and excitement, well then buy yourself a PlayStation. Okay, this is a business. You've heard me talk about it like that all the way through the last year. Okay, this is a business, and you need to look at it like that, and that is what will help you succeed. So, as I said, don't necessarily focus on trading, which might seem a bit strange for me to sort of say, but people get caught up in the trading, the buying, the selling, all right? But actually what you want to do is focus your time and energy on planning, all right? If direction is not clear on that chart, well then let price lead the way. Remember, we've talked about it all the way through here, okay? Is that when you look at a chart, a good trend will leap off the page here. If there isn't a good trend leaping off the page here, then there isn't that market. It's probably choppy or it's probably consolidating, and you're best to leave it alone for the moment. Yeah, and as it says there, you wouldn't fly a plane in zero visibility, and you wouldn't scuba dive in zero visibility. So why trade when the possibility of profit is zero then? Okay, when markets are choppy or not doing what you think they're going to be doing, why would you try and trade that? And so that's really becomes about, looking at, being a profit planner rather than just a trader, okay? And so the way I do it is that, for myself, I've built very simple, repeatable tactics. I wait for them. I plan my trades, okay? And what that does is it prevents me from getting caught in trading. It prevents me from making knee-jerk reactions, okay, about trading. It helps develop patience, consistency, and confidence. And if you want to do a little example of that, well, what I say is just sit and look at a chart. It doesn't matter what the time frame is. practice visualizing the next 12 candles. All right, practice just looking at where you believe the next 12 candles will show. What you can do is actually just print off the chart, okay, and draw them in. All right, draw them in where you think they're going to go, and then just check, check back against them to see how it developed. So yeah, rather than reacting to price, look at setting a trap. That's what I like to think of. It's about having a plan and planning for profit. That's what we're looking at. So when you logically plan your profit opportunities, you stop making silly trades, ladies and gentlemen. Okay? You have more control of your trades. You develop consistency in your trading, which means you become more of a confident trader. And that experience makes you a better trader. So think about that. Think about, rather than just thinking of yourself as a trader, start to think of yourself as a profit planner. Start looking at markets and charts as a place where you can plan for profits. And Mr. Livermore said there, sorry, I don't know why the slide has got a bit crunched up there, but after spending many years in Wall Street and after making and losing millions of dollars, I want to tell you this. It never was my thinking that made the big money for me. It always was my sitting. And what he's talking about there is actually him being a profit plan, about him sitting, getting ready, having a plan. And that's why, rather than just leaping in with both feet and just buying and selling, just impulsively. So, one of the ways we can do this, one of the ways that can help us do this, okay, is, is to actually start to keep good records. And, Dr. Alexander Eller wrote a very good book called Come Into My Trading Room. And he made a great quote that, show me a trader with good records and I'll show you a good trader. And he's absolutely right. In my 10 years of working with traders and helping develop them, all the traders who have good records are the ones who tend to go on to do well as traders. And that's what I want for yourselves. So, let's have a little look at our scene. Okay, so we've planned our session ahead. That's what we look to do. We've conducted our pre-market routine to get ourselves in the right space. We've decided to trade. We've understood we're in an ideal trading state. We developed our trade plan for the session. We traded our plan during that session. Session's come to an end. Well, then what? What are we looking to do? Well, then it's time for records and review. That's what we're looking to do. What we can need to do is to start to keep good records, and the three basic records you can start with are a trader spreadsheet, a trade journal, and an equity curve, but also a grade card. And we're going to look at the spreadsheet, the journal, and the grade card here as a quick recap. So, you have a trader spreadsheet Excel. These days, you can actually buy, very elaborate and expensive versions. But realistically, you can also keep very simple Excel spreadsheets as well that will help you start to sort of just develop and understand your trading at a better level. And that sort of spreadsheet should have details such as, the date of the trade. What day was it? Okay, is it Mondays or Fridays or Wednesdays? Is it a trend following or is it a reversal trade? What was the strategy that you employed, and what was the time scale that you executed on? What was your outlook? Okay, were you looking for that trade as an intraday or as a swing or as an end of day position trade? What were the outcomes, and also what was the performance and execution grades for your trades? And this is why I talk about having a grade card, okay, is that, what you should do is you should track and rate the performance of all your trades as follows under two headings: performance scoring and execution. So you can see performance there, you get 5 out of 5 if you hit your target, you get 1 out of 5 if you hit your stop. Whereas execution, well, you get 5 out of 5 if you followed the trade as dictated in your plan, or you get 1 out of 5 if it was an impulse trade. You're just jumping in, okay, you're responding to what you're seeing in the market and just taking an impulse trade. And it actually becomes really, really interesting once you start to plot these or capture this for every trade and then start to plot it. You'll be amazed to see what actually starts to show up with your actual trading results. What we should also start to do is, and once we're keeping the spreadsheet, is actually to fill in a trade journal. Okay, fill in one for every trade. If you're, I appreciate that's easy if you're an end of day trade on the daily charts. But if you're trading, let's say 10, 20 times a day because you're a higher frequency intraday trader, well then appreciate filling one in for every for all 10 or 20 trades might be a challenge. So what I suggest is you fill them out for your best couple of trades, your best worst trades, and any trades that actually start to capture your imagination. But it's important for you to capture all your details of the trade, but also what were your feelings about the trade, okay? And furthermore, what did you learn, okay? What did you learn from the trade? That is unbelievably important. Once again, Mr. Basso here, and I'm sorry, apologies about that. It's the slide has slipped for some reason. It's changed again there. Once again, Mr. Basso says that every time I take a loss, I need to learn something from the experience and view the loss as the tuition at the College of Trading. As long as you learn something from a loss, it's not really a loss. I stop looking at losses as problems and start viewing them as opportunities to elevate myself to the next plateau. And he's absolutely spot on right when it comes to trading there. Okay, view a loss as tuition at the College of Trading. Okay, instead of sort of worrying about it, just use it as an opportunity to make yourself better as a trader, and that is what will help you. Then we had step 9, okay, which was review. You might remember, ladies and gentlemen, right? So, we've collected all these good records. At the end of every day, review your trades. Then again at the end of every week, and then again at the end of every month. And you can use that data within your Excel spreadsheet to work out some important KPIs, key performance indicators. Things like your win-loss ratios, your risk-to-reward ratios, and your expectancy ratios. And it will also help you to understand developing trends within your trades. So some of the useful key performance indicators that you can take on board are things like your number of trades placed, right, or the number and or the percentage of winners versus losers. You also want to understand what's the size of your average winner, what's the size of your average loser. It's also useful to know, what is your average time in a trade? Is there something there that you can actually start to work out? Whether there's a particular time limit where if the trade doesn't work out after a certain time limit, that actually you should really cut the trade, and by keeping the data and being able to understand that will help you enormously. You also might want to look at things about understanding how many of your numbers of your long trades or buy trades versus the number of the short trades. I myself, I realize from my data that actually 2/3 of my trades are on the short side. I'm really quite bearish. I'm really a short seller. That's what I like to look for. And once you've got all this data, you can start to work out your expectancy. Okay, do you have positive expectancy? You can work that out by dividing your percentage of winners, the average size winner, by your percentage of losers at your average loser, and that will give you a number that allows you to recognize whether you actually have, as I say, positive expectancy, which means that you can how much you can generate depending upon your how much you can expect back, depending upon how much cash you employ in your trading, or alternatively negative expectancy, how much you're going to lose over a particular sample size. And what I suggest to everybody is that every month, once you've got all these records and you're able to review it, is that sit down and write a report as if it was writing a business report. Okay, so I mean these numbers, for a good few years ago when I worked at a hedge fund, but for that particular month I had a 70% win ratio, 38% of my trades were reversals, 62% of them were trend following. 50% of my losing trades were on a Friday. That's interested information, right? That's if you're 50% of your losing trades are on Fridays, well, what do you think would be a good move to do as a trader? And realizing that your average performance score is like 3.5 out of 5, which is fine, but my average execution score was 4.95 out of 5, and that is key, right? That is very, very important. We want the execution score to be as close to 5 as possible. The performance score will change, will go up and down, but actually it's the execution score that we actually want to keep an eye on. That is absolutely crucial for us. Once you've done it for your overall trades, then you can start to do it by strategy, individual strategy, so you can start to work out how successful and effective they are. So that was one strategy called the magnet, which was intraday scalping. So in that particular month, there was 44 trades. Okay, it generated net points of plus 266 pips. It had a 73% win ratio, and its reward to risk ratio was 1:1. So if you remember, ladies and gentlemen, when we looked at that slide earlier on, okay, risk to reward ratio is 1:1, but we have positive expectancy because we also had a very high win ratio for that particular month. So it's important to realize, it takes 10,000 hours or 7 years to become an expert at something, ladies and gentlemen. So, the way you speed up that process is to use constant debriefing. Every time you relive a trade, you're cementing the learning, all right? Losers see record keeping as a waste of time. Professionals see it as an investment that develops and improves performance, which therefore improves your profit and loss over time. It tells you how you're actually doing, which can be differently from how you think you're doing, and that is absolutely crucial. As I said, amateur traders focus on a method, professional traders focus on their mindset. Good traders treat this as a business, and a trader's journey is full of fear, hope, and greed. You've been warned. Take your time and enjoy the journey. Always aim to plan your trade and trade your plan. Focus on how well you execute your tactics, and let the money take care of itself. As we covered a little earlier, look to move from trading to profit planning. Good records are a sign of self-awareness and discipline. It's absolutely true. Discipline is one of those keys to trading success. Remember, we talked about it. Process, discipline, self-awareness. Debriefing is key to improving in performance. Making mistakes is fine, but repeating them is criminal. If you're keeping good records, you're less likely to repeat them. Records and debriefing speed up your progress towards trading success, and they allow you to adjust your trading plans on the back of hard data, not simply gut feeling. And as Dr. Elder says, show me good records and I'll show you a good trader. It's absolutely spot on. So, as I said, keeping good records and reviewing them is absolutely crucial as a trader. Keeping good records, single most important contribution to your success. If you maintain scrupulous records, review them and learn from them, your trading performance will improve. It's absolutely spot on right there. Absolutely right. And then finally, we had step 10, which was to repeat. Okay, repeat the process. So, it's repeat the process to build consistency and discipline. Remember, okay, when all said and done, professional traders have rigid rules and flexible expectations. Amateur traders have flexible rules and rigid expectations. I'm just going to say that again. Professional traders have rigid rules and flexible expectations. Amateur traders have flexible rules and rigid expectations. Hopefully you can see the difference there, okay? And hopefully you can, see how maybe that has had an impact upon your own trading. Have you had flexible rules, okay, about how you can trade? And have you had pretty rigid expectations on what you expect from the market? And invariably, when you trade that way, you normally end up failing to meet your expectations. And really what I've realized over the years is that the majority of my coaching work that I do with traders on a one-to-one basis is simply this: turning amateurs with a hobby into professionals with a business. And it is so true, okay? You're either an amateur with a hobby or you're a professional with a business. And that choice is yours. That choice is yours, okay? But all I say to people is, most of us have hobbies. Maybe, I don't know, maybe you like playing golf, maybe you like stamp collecting, maybe you like to build remote control cars, whatever your hobby is, that's absolutely fine. But most of us realize that we expect to spend money on our hobbies, but we expect to make money from our business. And that's the way to look at it. It's a simple mind shift change. And that's what we've, been talking about all of this particular session. So how do you do that? How do you become a professional with a business? How do you build consistency and discipline in your trading? Well, I've stressed since the start of the Mastering the 4 M's of trading is that, we look to plan our trades, trade our plan, manage our risk. That's what we look to do. Plan your trades, trade your plan, manage your risk. Those are 3 things that are within your control, ladies and gentlemen. They are absolutely within your control. What happens once a trade has triggered? Well, anything can happen, all right? Anything can happen. But planning your trades, trading your plan, and manage your risk, they are all within your control, and that's what you should be looking to follow. So what we can do is, we have a tactical trading plan. How do we engage in the markets day to day? What we've covered, okay, over these last year is about having that tactical trading plan, those 10 steps that you can follow day in, day out, week in, week out, month in, month out, quarter in, quarter out. You also need to start to build a bit of a strategic business plan, how you plan to run and build your trading business. This great quote from Sun Tzu, the Chinese general, said, "Strategy without tactics is the slowest route to victory. tactics without strategy is the noise before defeat. And I see that a lot in traders, okay? Either that, they have a grand plan, but they don't actually have the tactics to help them engage with the markets, or they just have, a trading method, a trading tactic, but they don't really have an overall strategy in how to employ it, and, they're just making the noise before defeat. And, the Sun Tzu is from thousands and thousands of years, ago. That quote is equally available and valid today as it was many thousands of years ago. So, in terms of a business plan, well, why bother one for your trading? Remember, it's about being a professional with a business, and all sustainable, profitable businesses have a strategic business plan. That's what they all have, okay? It doesn't matter who they are, they all have a strategic business plan, and that's what we're looking for. So why bother with one for your trading? Okay, why bother? Well, because what you find is that without one, traders start to struggle, and they struggle with overconfidence or the need for variety, or perhaps even the need for excitement, and then the need to be trading. Remember what we said pretty much right at the start of this session? Don't just get involved in the sort of being in trading, but actually think of yourself as a profit planner, right? That's actually easier to do when you have your own plan, when you actually have, how you go about your business. If you just switch on the computers and sit there, if you've had a good couple of days, you'll be filled with overconfidence. Or if you've, not done much, you'll be bored and you'll have a bit of a need for variety. Perhaps you might need a bit of excitement. Okay, maybe you're a little bit bored. Maybe you feel like you just need to put a trade on because you're a bit bored. All of those things, are actually very, very poor. Okay, they tend not to work out well for traders. It's about actually understanding, once you have a strategic business plan, well, then it helps you sort of overcome those particular struggles. If you want to read more, understand this, there's a great book there by Mr. Nicholas Darvis about, I think the book's called How I Made $2 Million in the Market back from the 1950s. And the reason I mention it is, Mr. Darvis, he used to trade from, he had a good trading plan, and he sort of, he actually traded from afar from the market. Okay, he was actually traveling the world as I think a dance choreographer, and would just trade doing end of day trades. He had some success at that. So what he decided to do was he decided to actually get an office just off the back of Wall Street, get himself the ticker tapes, which is what was actually, in those days, how you'd get the updated trade movements. And actually, he thought that he would become, far, far more successful, being able to spend all his day there just trading, day in, day out. Actually, it turns out his trading was actually very, very poor. His trading went, decidedly badly for those kind of 6 to 12 months. Because what he realized is that he was too close to the market. Okay, he was being too close to the market. He felt the need to be trading. He felt the need to just pull the trigger on trades. Okay, he felt the need to just be, taking trades, and so his trading became, instead of it being, well planned out and well thought out, it was impulsive. It was knee jerk. He was chasing his tail, and in doing so, he actually traded poorly. And actually, what he did was, after 6, 12 months of that, he closed up the sort of that trading shop, and he returned to his old life as a dance choreographer traveling the world, and actually went back to trading as he did at the end of the day, away from the market after the market had closed. Getting in those days, he would actually get the trade prices telegraphed to him. And then he actually went on to have a really great year and made $2 million in the market, and that was 50 odd years ago and such. So that was a very he traded very, very well. But it is that it's a real life story about how not having a plan or being too close to the market and just indulging in those kind of needs to be trading actually invariably that kind of damages trading performance overall. So if you want to create one, you don't need to. It doesn't need to be perfect. You just need to start, okay? And you should ask yourself these questions, okay? And because it should involve stuff like who you are and what's your purpose for trading. What are your trading goals for the year? All right. What are the markets, the instruments, and timeframes that you will look to focus on trading? What are the trading tools that you have access to? The resources that will help you. What are your routines? Okay, remember we talked about process, discipline, self-awareness, and part of process is about having good routines. Risk management and money management, that should be down there. We've covered that plenty over the last few weeks. about what are your contingency plans. What happens if you have trades on and then suddenly, your computers, blow up, or you lose all the internet wherever you are. What are your trading systems? What are your methods? And actually, how do you go about recording and reviewing trades? All of these details should be in there. People sometimes get a little bit, they're a little bit overwhelmed by that. They get a little bit inundated by, the sort of the amount of work they think. Doesn't need to be perfect. You just need to start, sit down, take a sheet of paper, go through it, start to work on it. And as you go through, you'll be able to develop it. So, remember for that step 10 about repeating. In conclusion, amateurs see strategic business plans as a waste of time. Professionals see it as an investment that develops and improves trading performance. So the question for yourself is, do you have yourself a strategic business plan and a tactical trading plan? If not, well, make a commitment today to create them going forward. Because the simple question is, are you an amateur with a hobby or are you a professional with a business? So remember, ladies and gentlemen, just for one last time, okay, very quickly, let's go through our 10-step of the tactical trading plan. Step 1, define levels of support and resistance. Step 2, define if there is a trend. Step 3, wait for price to see how it reacts at key support and resistance levels. Step 4, look for price action signals at support and resistance levels. Step 5, is it part of a bigger chart pattern? Step 6, risk. Define your risk, accept it, and stick to it. Step 7, reward, okay? Are you going to have a target or are you going to use a trailing stop? Know your exit. Step 8, record. Make sure you keep scrupulous records so that in step 9 you can review them, because by reviewing them, you improve your performance by debriefing your trades. Step 10, you repeat. And the way you repeat is that it builds consistency and discipline. It's very hard to be consistent without being disciplined, very hard to be disciplined without being consistent. So there you go. That was the 10-step tactical trading plan, which is what we've looked at mostly over the last year, okay? And I say just make a note of that, draw it out, use it every single day, just work on it and use it as the sort of the basis, as the framework from which all of your other trading endeavors may unfold. So remember, okay, for one last time, the big picture recap is that you should always be looking to master those 4 realms of trading: markets, methods, money, and myself. Always check in, are they in alignment in your own trading business? If they are, fantastic. If they're not, well, then don't expect outsized returns. Constantly monitor those 4 areas. It doesn't have to be formally, it can be informally, but just make sure you're doing what needs to be done. So there we go, ladies and gentlemen. That's the end of the Mastering the 4 M's of Trading webinar sessions. And as I said, I wish you every success in your trading endeavors, and use these Mastering the 4 M's sessions to help keep you progressing and developing as a trader. If you haven't seen it already, it's not the end of my own conversations with you. From the start of next week, as we go into August, we'll actually be starting with a Trading Spotlight webinar series, and you'll see the advertising and the for that from the Admiral Markets marketing team. If you haven't seen that already, make sure just have a little look on the website. You'll be able to find the links. We're going to be talking about a whole wide range of exciting trading topics. So by all means, I look forward to you joining me for those sessions. And as always, I wish you the very best of success in your own trading, and I look forward to speaking to you soon. And as always, just to finish off, invariably, as always, if you have any questions about this session or Admiral Markets in general, you can contact them on that London number 02035 140 756. Email them at hello@admiralmarkets.com. You can watch this and all the other sessions on youtube.com/Admiral Markets, or have a look on facebook.com/Admiral Markets Global. Many thanks for joining me, and as I said, wish you the best of success in your own trading, and I look forward to you joining us for the Trading Spotlight webinar series from the beginning of August. Trade well.